when I was writing about the economy last night and the economic outlook of the Australian Treasury is the understated power of the Australian economy. You can see that in the relative size of the budget deficits. For example, the Australian budget deficit was fully 2% of GDP better for this financial year than was anticipated only in October. So instead of running a deficit of 9.5% of GDP, we're running a deficit of 7.5% of GDP. And if we compare that to what other countries are doing, our budget deficit is 7.2% of GDP lower than the US budget deficit, which of course inherently suggests that we can expect the Australian dollar to be stronger than the US dollar, and maybe that's already happening. But what I wanted to do today was contrast two different views of the Australian economy, which have been released within days of each other. On Friday, we had the quarterly statement of monetary policy of Reserve Bank of Australia, and that includes not just an outlook for the Australian economy, but it also includes quite detailed commentary of things like the market for iron ore. Now, I had said in a piece that I published last week that I thought that through the year measure, the year average measure for growth in the Australian economy was 5.25%. And that's a really high number. And how I came up with that number was based on the Federal Reserve estimate of 6.5% growth for this year. And there's a slightly higher estimate, what's called the blue chip consensus, major forecasters of 6.7%. So I was kind of interested on Friday that in comparison to my year average growth rate of 5.25%, the RBA came out with a year average growth rate of 5.25%, which is very, very powerful. But when we look at the Treasury numbers, the fastest growth number we can get is the year-on-year growth number of 4.25%. So what we have underlying the RBA outlook is an inherently stronger growth, which I think is more realistic than what's happening in Treasury numbers. Treasury numbers are good, but I think that the RBA is just a little bit more on the ball about strength. Now, that's really, really good if you want to go forward and be producing even better results in terms of deficits and have more money to spend at election time. You should be underestimating your future growth. That's good. Actually, the comparison within the two documents between the RBA outlook and the Treasury outlook is more pronounced in the out years, that is to say, years like 23, 24, 25. And because of that difference in growth, you get to a level of low unemployment, which in both cases is unemployment falls to 4.5%. Except in the Treasury, in the RBA case, you get there about a year and a half faster. So that means that when you're getting towards around about 24, 25, and you've got that low unemployment of 4.5%, you're going to have faster wages growth then and a return to a broader prosperity in the Australian economy. One of the things that supports this in the RBA outlook is the outlook for iron ore. Now, we know that China has been talking down the iron ore price, not with much success, over the last month or so, talking about how it's going to reduce production and that kind of stuff. But what the RBA outlook shows, which is on graph 1.12, is that steel production is at an all-time record high in China, and steel imports are equal to an all-time record high. And that's also interesting when we look at in the budget papers the assumptions about future iron ore prices, because they assume that the iron ore prices will actually decline to $55 a tonne by the end of March next year, which is around about a quarter of the current price. I think our modelling and that of the RBA would show that the iron ore price is going to be significantly higher. And again, the budgetary outlook is going to be much better next year than the Treasury numbers suggest. So what we have here, when you read the piece, is a good outlook, but when you look behind how that it's prepared, the actual outlook for the Australian economy is better, and we'll probably have slightly faster growth with smaller budget deficits and lower unemployment and higher real wages growth than the Treasury allows. But that's a good thing, because it allows the government with a much more flexible position to move from at next year's election.